let's just jump right in. Welcome to this explainer, where we're going to trace the exact path your money takes from the central bank straight into your wallet. You know, if you've ever felt like the financial system is just this giant, confusing black box, well, today we're prying it open. We're looking at exactly how decisions made at the very highest levels of the Reserve Bank of India ripple all the way down to the actual cash in your pocket.
I mean, think about it. You get that notification that your home loan EMI suddenly changed, or you notice bank deposit rates just seemingly bouncing up and down out of nowhere. It can feel totally random, right? Kind of frustrating. But the answer to this everyday financial mystery is actually completely structured. It all comes down to a very specific chain reaction, and it's triggered by two absolutely crucial tools used by the Reserve Bank of India, or the RBI.
Okay, so let's dive into the first major concept here, the repo rate. Simply put, this is the interest rate at which commercial banks borrow money from the Reserve Bank of India for their short-term needs. To really wrap your head around this, just think of the RBI as the ultimate banker for all the other commercial banks. When your local bank is running short on funds, they can't exactly go print more money, right? They have to go to their bank, the RBI, to borrow it. And yep, they have to pay interest on that loan. That specific interest rate, that's the repo rate. Let's trace how this actually creates a directional flow of liquidity. It's really a straight, logical path. It starts up at the central bank, flows down to your commercial bank, and eventually trickles all the way down to us, the customers. This flow is literally the backbone of our economy. Whatever happens up at the source with the RBI directly impacts your commercial bank, which inevitably dictates the interest rates you and I end up seeing.
So what happens when they tweak the system? Let's say the RBI increases the repo rate. Instantly, borrowing becomes more expensive for commercial banks. And let's be real, banks aren't just going to absorb that extra cost. They pass it straight down the line to us by jacking up loan interest rates. Suddenly, those home, car, and business loans become a whole lot costlier. The ultimate result? Money circulation in the economy actually drops, simply because people borrow and spend less. The RBI does this very intentionally, by the way, when they need to hit the brakes, cool down the economy, and bring inflation down. But let's look at the flip side. When the RBI lowers this rate, borrowing becomes cheaper for the banks. And to stay competitive, those banks turn around and reduce their lending rates. All of a sudden, those exact same home and car loans look really affordable. People are incentivized to borrow, so spending and investment increase across the board. Basically, by doing this, the RBI is injecting cash straight into the market and giving economic growth a massive boost.
Now, what if we flip the whole scenario? What happens when banks have excess cash instead of needing a loan? Well, that brings us to our second big concept, the reverse repo rate. This is the interest rate the RBI pays to commercial banks when those banks park their surplus funds with them. Imagine your local bank is just sitting on a ton of excess cash from customer deposits. They probably don't want to risk lending absolutely all of it out into the open market. They need a safe place to stash it where it's still going to earn a return. So they deposit it right back with the RBI. You can see how the plumbing runs in the exact opposite direction here. The commercial bank pushes its excess funds back up to the Reserve Bank of India, and in return, they earn a totally safe, risk-free interest return. It's actually a brilliant mechanism for sweeping up extra liquidity from the banking system without introducing any new risk.
And just like before, twisting the style has massive economic consequences. If the RBI cranks up the reverse repo rate, they make depositing money highly rewarding. Banks are going to look at that high risk-free return from the RBI and say, yeah, we prefer that over the risk of lending to everyday businesses and consumers. So lending to the public drops. By making these deposits so attractive, the RBI is effectively incentivizing banks to hoard their cash rather than lending it out to you, which securely controls the money supply and curbs inflation. Conversely, when the RBI decreases the reverse repo rate, banks suddenly earn a lot less by keeping their money tucked away with the central bank. The reward just isn't there anymore. So if they want to make a profit, they're pushed back out into the open market. They take that cash and lend more money to customers like us. This directly increases the liquidity floating around in the economy. It's essentially a giant tap that the RBI can twist to flood the market with cash when needed.
Okay, to bring all of this into crystal clear focus, let's contrast these two forces. If you remember one thing, remember this fundamental difference. With the repo rate, banks borrow and the RBI charges interest. That controls lending, and higher rates mean costlier loans for us. With the reverse repo rate, banks deposit, and RBI pays them interest. That controls overall market liquidity, and higher rates mean less lending to the public. It really is that straightforward when you put the two mechanisms side by side.
Ultimately, both the repo and reverse repo rates are incredibly powerful monetary policy tools. I mean, they aren't just dry, abstract banking jargon. They are the exact levers used to control inflation, manage liquidity, and support economic growth on a national scale. Grasping these high-level maneuvers is absolutely essential. Why? Because it equips you, whether you're a borrower, an investor, or honestly just an everyday consumer trying to budget, to make much smarter, more informed financial decisions in your own life. So here's the real test. The next time your bank updates your loan EMI, will you be able to trace that ripple effect all the way back up to the RBI? I highly encourage you to keep this central banking chain reaction in mind. Understand that your wallet is directly, permanently plugged into the decisions made by the central bank. Once you see the matrix of how this money flows, I guarantee you'll never look at your monthly bank statements the same way again. So, looking at today's economic climate, which lever do you think the central bank is going to pull next? And, more importantly, how are you preparing for it?